What you're telling me is that music is about to stop, and we're going to be left holding the biggest bag of odorous excrement ever assembled in the history of capitalism. 1974, 1987, 92, 97, 2000, and whatever we want to call this. It's all just the same thing over and over. We can't help ourselves.
I say when we sell. Hey, I say when we sell.
All right, everyone, welcome back to The Last Trade. Today we're joined by Jeroen Blokland and, of course, my co-hosts, Michael Tanguma and Jesse Myers. How is everyone doing today?
Doing great.
Right. Jeroen, great, great to meet you. We're just catching up a little bit before we hit record, but really excited to have you join today. I know we've just got recently connected, but was able to do some homework leading up to this podcast. And really, there's a lot of synergies and alignment between how you seem to approach the global investment landscape and specifically sound money assets or scarce assets such as Bitcoin and what we focus on here at Onramp. So I think it'll be a great conversation. You have 20 plus years of investing and portfolio construction experience, multi-asset investor, managing multi-billion-dollar portfolios. Now you're the founder and manager of Blokland Smart Multi-Asset Fund, which invests in a combination of scarce assets such as Bitcoin, gold, and quality stocks. So maybe you could just start by walking us through the past 20 years or so. I'm sure there's plenty we could talk about there, but if you want to just give us an overview of the career path that you've taken, some of the notable work that you've done, and where you find yourself today, I think that would be an excellent place for us to start.
Yeah, okay. Well, first of all, thanks for having me. I agree that there are definitely synergies in what we do and bridging a gap. I feel right in the middle of the traditional and old investment world. My background is from the traditional investment world. So I worked for over 15 years with the biggest independent asset manager in the Netherlands. And my latest role before I left was the head of multi-asset solutions. So my team was in charge for all non-pension related multi-asset funds for retail and institutional clients. This is basically my key career path in the sense that I've always been involved with multi-asset portfolios, and I have seen so many other asset managers, portfolio managers falling in love with their own asset class. Well, the thing with multi-asset investing is there's always some asset class to like and also to dislike. So you don't have to fall in love. But I guess I like a couple of them better than others, but we will talk about that a little bit later. A couple of years ago, I always had the urge to start my own company. I have friends who have done that. I find it intriguing. It's another idea of realizing something from the scratch. So I started a research company, which was fine. I think that's the best word to describe it, which was fine. The most important thing that was lagging was I did not have a solution ready for my clients and people that I spoke to. So a lot of people like reading research, but in the end, the question is, can you not do it for me because you have this experience in the asset management industry? So after 2.5 years, I told my wife I'm going to spend a lot more money, even though I had not had a salary for a couple of years. And she was, okay, we have 2 small kids, right? But then I decided to launch my own fund. And the reason to do it by myself, first of all, an ex-colleague of mine has done the same thing, totally different fund, by the way, but I could look at his path, how difficult or not difficult that was. And the other thing is that when you do this from scratch, you keep maximum flexibility. So when you start a fund that invests in the 3 asset classes, quality stocks, physical gold and Bitcoin, that is literally in between nothing. So it is a bit of not a gamble, but you don't know if that will attract investors from either side, because on both sides, they have difficulties aligning the different asset classes. But yeah, that turned out great. I could tell my wife after 4 months, this is it, this is going, this we'll make it. And that is where we are now. So we now go in the 9th month. And we attract quite a few assets, and yeah, we have all kinds of idea how to expand it. But yeah, I think I will be doing this for quite some time now. So I'm back, portfolio manager, still very active on social media, trying to connect these worlds, and yeah, that's the main game.
That's such a fascinating story, and I can see how maybe in hindsight it looks obvious. Yeah, people would love Bitcoin, but to your point, you're pulling on almost two extremes. Like you have equities, right, that are exposure to an underlying value that's physical and tangible, and then you have this digital asset that nobody recognizes. And so it's like, well, is somebody going to be interested? But the other side of it is, well, maybe there's a lot of interest because maybe somebody doesn't want concentrated exposure to BTC, but a little sprinkle on top is very interesting. Curious, like how you came up with Bitcoin as the second, gold and equities make sense, but how did your journey to Bitcoin come about, and how did you figure out how
Yeah,
to size that?
yeah, yeah. Excellent question, and one of the most asked questions, of course. So maybe also in that whole career path, in 2021, I wrote a piece for my company about Bitcoin. Is this an asset class? So I went to all the standard characteristics: risk, return, diversification, size, liquidity. And that went up to the board if we could publish this, because yes, traditional asset managers are not that keen on exposing themselves. But yeah, the idea was, if we do not say something about it, we don't have to invest in it immediately, but we have to say something about it. Myself, I invested for the first time. I bought Bitcoin for the first time in 2013. A lot of people are surprised when I say this. And obviously, that was not because I think that Bitcoin would become so large or such a big movement. This was mainly if one of my principles, so to say, is if you are going to speak about something or say something or research something, you have to experience this. So all of these stories with the potential of losing your computer with the codes, all of these wallets that did not work anymore with the updates, all of these things I went through. It was not until I think 2019-ish that I saw some of the potential that I see now. And then back to your question, why add Bitcoin to the mix? The whole idea, of course, of my fund is scarcity. But also I'm very realistic that we live in a digital world. Our debt is digital. Our money is digital. We want to have everything digital. Why not a digital kind of gold or a store of value, or something that potentially, and I hope we can talk about that a little bit more, rebalance, let's say, the financial market. And because this is also, I'm in between those worlds. I don't think we need a doom and gloom scenario by definition to make these assets, gold and Bitcoin, great. So I'm very much of the idea that there can be a market-driven gold standard or Bitcoin and gold standard, as long as these asset classes rise in their value relative to the digital debt and currencies. Then for every dollar in debt, there is more store of value behind it. And that was basically the idea of the gold standard. The only thing, of course, and that brings me to the portfolio, you have to participate. If you sit back and wait for others to do it, central banks to do it, for Bitcoin maxis to do it, for gold bucks to do it, then you do not participate in this whole great rebalancing thing, right? So that is my idea. I like gold and Bitcoin. I like gold because it has 5,000 years of track record being a store of value, being a safe haven. I like Bitcoin because of the technology, the fact that it is built to be scarce, and that it fills the gap that gold cannot in the digital space, but it has a track record of 15 years, to be honest. And also it has quite some policymakers, central bankers that will be against it, right? That we have to be very clear. I think gold is much more liked by central banks. Take the Central Bank of Poland. They are buying gold like there was no tomorrow, right? So you have to. So for me, these three are very sound. And maybe then one remark on the quality stocks, because everybody understands stocks. But why quality stocks? Well, quality stocks, as the name already suggests, these are companies that are special. So there are two scarce elements to quality stocks. First, there's a lot of buybacks. So that means that equity capital relative to debt is becoming increasingly scarce. So if you look at all the budget deficits and so, and second is that a quality company can do something that other companies can't. They have low debt levels and they have reasonably stable earnings. And in my case, that means if you have the MSCI World, you throw 80% of that MSCI World, the number of stocks you throw away, and you keep the top 20%. And that also means that you have a very specific subset of equities, which I then call scarce.
At Onramp, we believe that Bitcoin is the most important asset of the 21st century. The hard part is securing it right. There are shortcomings with keeping your coins on an exchange, but also with setting up your own self-custody arrangement. Onramp solves for these concerns. Our multi-institution custody solution maximizes security and minimizes counterparty risk, ensuring that your Bitcoin remains securely in your possession, and provides built-in inheritance planning to ensure your family is protected as well. Onramp provides peace of mind for your Bitcoin journey, whether for your whole stack or for part of it as a complement to your existing self-custody setup. For more information, check us out at onrampbitcoin.com.
Really appreciate that background, and fascinating to hear that you were first in Bitcoin in 2013, just to have some skin in the game and to be able to actually experience digital scarcity and start to understand things, right? And go through, you had mentioned some of the challenges in terms of self-custody. And there's certainly a lot we'll talk about there later in the conversation. And also appreciate the overview just in terms of your portfolio management process and construction, thinking about quality stocks, precious metals such as gold, and Bitcoin. There's a lot I know we'll want to get into on Bitcoin specifically. I am curious, before getting further down the Bitcoin rabbit hole in this conversation, just to hear a little bit about how, those 20 years of investment experience in multi-asset, like you had mentioned, not getting married to an asset class, right? Being able to change your mind and be dynamic and like an asset class in a certain environment and dislike others during that same environment. So maybe could you talk about why you chose to focus specifically on, like we talked about it at a high level, but specifically on these three asset classes as part of your, the anchors in your portfolio, and why those three, and what circumstances exist today that maybe didn't exist 5 or 10 years ago that allow for this new type of portfolio construction to benefit investors?
Yeah. So obvious question. So whenever you think of a philosophy of your investment framework or your investment thesis, it has to be simple, right? Because if you look at the number of multi-asset funds already that are out there, they're gigantic. So for me, the whole idea is basically, if you have one asset class that is the core of most portfolios. So most people, to a certain degree, invest along the 60-40 narrative, right? So for some younger people, it's 70-30, but they have equities as one of their core holdings, and then they have bonds. So that's the 60-40 idea, of course. Now, it's extremely clear, it's objectively clear that one of these core holdings are abundant. So the word that I use is abundant. So if you look at the amount of debt that is in the financial system, the amount of debt that is added to the financial system, I have this chart of the budget deficit of the US. There's no war, at least not close to the United States. There's no recession, and they're running 6 to 7% budget deficits. This is truly amazing. It never happened. There is this chart that shows the only times we had similar, but even sometimes a little bit smaller budget deficits are during the wars, right? So it is abundantly clear that one of them is abundant, and then you can take the dictionary and you look up what is the opposite of abundant, and that is scarce or scarcity. Now, and then that is basically where I start my journey. And then, of course, you look at the traditional world and the, let's say, alternative world, and you look for the best scarce assets that are out there. Now, we already discussed Bitcoin, and we will do a little bit more. I think gold stands on its own. Most people acknowledge the scarcity. Of course, some people then dislike it because it has no cash flow, which is fine if you believe that, but it's irrelevant if you think what the purpose of gold in a financial system is. But okay, whatever you want. And then in the end, there are three assets left: one from the traditional world, two from the alternative world, so to say. Although gold is a little bit in between. So I have one of each side, and I cannot think of another one. We can talk about old-timers, but suppose I buy an old-timer, and 10% of my clients or 10% of the assets go out. At what point I cannot sell the steering wheel? I cannot sell the engine. At what point do I sell the whole old-timer, right? So the same as with fine wine. It's a nice asset class, but how do you really incorporate it in an investment framework? Now, we now have the blockchain art, which is very interesting development. So they buy Andy Warhol, they slice it into blockchain pieces, and you can buy and trade that. But that market is so tiny, so illiquid, right? So after doing, it didn't take that long. It's pretty obvious that you want to have these assets tick a couple of boxes. And for me, quality stocks, physical gold in a vault in Switzerland, and Bitcoin came out on top. And so far, I'm very pleased with that, because since we launched the fund, especially when it comes to gold, it's very clear that this is not some central bank, Federal Reserve pushed rally. This is a development, a trend that fits with, let's have some scarcity in our portfolios, because the risk return characteristics of those bonds in my 60/40 portfolio are not that great anymore. So that is basically which asset survives in this case the Blokland test. They did. Yeah.
It's a fascinating like logical progression and pragmatic progression that from someone that, like, I think it says a lot about yourself, and that you referenced you had to buy some to be able to speak about it. Because I think that is, I've never been that way. I mean, I'll talk about anything, and not, it's like, that's a very visceral, like, needing to touch it, which I think is probably a good, philosophy to have for almost anything, right? But then the notion that you're referencing, you said something early about the positive nature of where we end up with hard assets providing the seamless transition, right? So this notion of like gold or Bitcoin. And I think if you know of Leon Wonkum, he writes a lot about this, and kind of refinancing or incorporating BTC or potentially gold into debt, so you can help in from a structural perspective pay back. And that, I feel like, has manifested either subconsciously or consciously in your portfolio construction, because there's this notion that most people will be okay with equities, scarce equities, premium equities, and then gold, and maybe a little bit of Bitcoin. And that's how you can outpace either the debt or what's a proxy is inflation, right? Because year over year, inflation equities are just barely keeping by, if not in real terms lower than inflation, which is ultimately the ultimate goal, right? Is to outpace, in real terms, the cost of capital or storing of value. And where I'm driving towards is, like, again, I'd be curious if this is intentional or not, but I can see how as debt increases and inflation increases, or purchasing power decreases, BTC can add to that portfolio mix as the investors become, it's less risky, they're more inclined, the performance increases, gold also is moving, and you can start to move out of that potential equity position into these other harder currencies like you referenced that can help reprice things.
Yeah. So the weights of my portfolio are now such that because I mentioned the 60/40 portfolio, what I want to do is give people a future-proof, so to call it, 60/40 portfolio. That means, and I think I cannot stress this enough, my starting point as a multi-asset investor was volatility, not the return. The volatility was my starting point. So my volatility in the backtest, of course, you have to do a mandatory backtest, is between 9 and 10% volatility, which matches the 60-40 portfolio through time, right? So you are right in the middle. The first 8 months, we now have data. The realized volatility of the fund is 8.8%. So it's spot on. And we all know, also when you have a little bit of institutional background, that volatilities are much more stable than returns. So my first thing I start to talk to people when I visit them, do you want to invest in my fund? I start to talk about volatility. Most of the time they do not fully grasp it, but when I explain it in terms of drawdowns and things like that and where it comes from, and then of course the result is the return. So that is one thing, and that indeed means that if this whole, let's say that in my world, central banks and policymakers will try to keep this debt-driven growth model for as long as possible, for decades if they don't want to. So, and this is also why this MMT is such popular, because it fits the narrative to postpone it. Because yes, US Treasuries are a nice asset on someone's balance sheet. Yes, if you do not ask the question who wants to hold those treasuries. If you end there, then it's perfect. You say, yeah, it's an asset. It's always an asset. It pays a nice return, which is also not the case. But so whenever the balance shifts to what you call sound money and I call scarce assets, then there is room to increase the weights of these scarce assets, as long as the volatility target is not impacted dramatically. So at that point, with volatility of Bitcoin of 70, there's not that much room for adding volatility. But in time, nothing is fixed, and indeed, I can imagine that the weights of these assets will change over time as my view of the world, how we can have this market-driven implicit gold, Bitcoin, scarce asset standard evolves. So there can also be the other way. If governments start to clamp down on Bitcoin and crypto really hard, then that process is perhaps delayed. So it can accelerate, but it can also be delayed. And this is also, nothing is fixed. You have to be realistic about it. And there's also, if you look at the information memorandum of my fund, it says that the strategic weights can change over time, but I will communicate about that, why that is, and things like that. So yes, I agree that some of these assets could larger. I must say that with my 10% direct Bitcoin exposure, this for traditional investors, this is crazy, but also 25% in physical gold is also pretty large. So but I have this gap of 40%, let's say, to fill, that old 60-40. And that is the whole idea. And now you see that mainstream media, financial media, there was this, the most written financial newspaper in the Netherlands, they did an article on that gold has realized an all-time high 20 times already this year, right? This is something you hardly ever see. You see, the state pension funds of Michigan revealing a small but Bitcoin ETF exposure. So my thesis is every day, a sound investor, not a speculator, will wake up, look at the data, look at what is going on, and says, yeah, maybe a little bit less of those 40% bonds. Give me 5% gold. Give me 1% Bitcoin. I don't know. And every time the Financial Times, the Wall Street Journal, I actually save it so that I can count it. Basically, every day there will be some kind of investor walk. And to come back to your question, at some point this likely will involve a reallocation of these scarce assets versus quality stocks, but I don't know how that will pan out. But yeah, that's definitely possible.
Yeah, one thing that. Go ahead, Jesse.
Well, I was just going to follow up on. It's very interesting having volatility be kind of one of the two parameters. Obviously, you're looking for returns, but you're trying to maintain volatility around the 60-40 classic portfolio. And does that speak to the types of investors that are interested in your fund vehicle? I guess what I'm really wondering is, does your fund product attract people to gold and Bitcoin who otherwise would not be investing in gold and Bitcoin because it's delivering, the performance that they're hoping for, but it's also sort of future proofing and providing like a defensive tranche to their portfolio? Or do you find that this is helping people who are interested in gold and Bitcoin get a larger percentage of their overall portfolio allocated to those asset classes because you're balancing this and reining in the volatility overall for something like Bitcoin?
Yeah. Both and even broader. So what was a massive eye opener for me, that let's say the groups of clients, so to say, are exactly those that you mentioned. So from the traditional world, what they do, they have a private banker, for example. They have this 60-40. They have 20 different thematic ETFs in their portfolio. It's really rubbish. And then they say, oh, I have nothing in these other assets where so many people are talking about. I see these debt issues, but I don't know what to do with it. I'm going to allocate some of my money to, in this case, me, to have some exposure to these asset classes, right? And of course, whenever I'm in, my goal is to prove to them that this is a much better proposition. So that is one thing. But and then also, but the other side of the investment universe is also part of my investor base, and these are the people that have allocated 80% to crypto, and not Bitcoin, but crypto. And they are tired of these crypto winters. They are done with that. They don't want to do that. So what they see, actually, even though my volatility is roughly 9, which still can have a drawdown of 20%, right? We have to be very open about that. They see my fund as a really safe alternative to continue having exposure to their assets that they like, but with some kind of let's say volatility risk management behind it, and they don't have to worry about it. And so I had this Dutch guy who joined me last month. He said, I'm so happy already. I don't feel the urge or need when I wake up to look at the prices, to look at what my portfolio is doing. And so to my surprise as well, the range of people wanting to do this, wanting to invest, is pretty broad. And I do think that it helps that I'm from the traditional world, having experience as a multi-asset investor, daring to look on the other side of the spectrum, right? So I think it's a combination of that. But so on both ends, I have clients coming in, and each with their own reason to invest and to manage their portfolio and their risk.
I think it's fascinating to talk through, because we always, whether it's on this show less, but behind closed doors, there's no shortage of talking about traditional portfolios, and we laugh at inflation or not inflation, but bonds and real returns, and how can people do this? But I also think they probably laugh at us, and that a lot of the people in our networks and groups are very over allocated to BTC. We've stomached the volatility, or kind of sick in that way. It's just like, but that's not realistic for most people, especially older individuals. And this really dawned on me probably 12 months ago. I'm sure you're familiar with Larry Lepard, who's a good friend of the show. And just referencing gold and where it fits in somebody's portfolio, it's like they cannot, like volatility is effectively just is synonymous with like psychology of the individual. And do they feel good about that volatility? Because, we know what Bitcoin's volatility return profile is, but at the same time, if somebody made their whole net worth, are they really 65 years old willing to see it draw down 70% or whatever the number is in their allocation? And between that and then just this notion of the Lindy of gold in 5,000 years, it's just like I personally, and I think this is a little bit, at least on the Bitcoin side, not common knowledge, but it sounds like, Jeroen, you follow along with this, that gold and Bitcoin play along for a very long time, if not forever. And that the like mimetic nature of the risk premium, I heard you say on Macro Voices about the insurance, that when this inflation persists and grows and debt grows, you said it earlier too, it's like 5% goes to gold, 1% goes to BTC. Like the notion that everybody just leaps frogs and goes to BTC while we'd like to is just not a natural instinct for most, which is just very interesting all around, because I don't think it gets talked about enough in the Bitcoin side of things.
Yeah, so let me add a little bit on that, because this is a key notion to talk about or to discuss. So going back to the traditional investment world. So suppose you are an institutional investor. So first of all, when you go to your boss and you talk about let's do Bitcoin only, that is a career risk, right? But also in practice, I mentioned that in 2021 I did this analysis on Bitcoin as an asset class, going to all these things. Now, one of the things that is extremely important, and you do not want to burn yourself on while having a new asset class, is size and liquidity. Size and liquidity. So suppose this institutional investor wakes up. There's this waking up again. He goes to the boss and says, "I think it's great to have these two asset classes in my portfolio," and that portfolio manages $100 billion US dollar or euros, whatever. So if you look at the size of gold, the liquidity of gold, I can tell you, even though no matter what they think, what their beliefs are, or where this could go, and that Bitcoin could go much faster in terms of return than gold, a lot of these institutional investors will have to go to gold first because the liquidity is there. So the market cap of gold, this is also something interesting. People continue to talk about the market cap, total market cap of gold being 16 trillion US dollars. It's extremely easy to calculate a real-time market calculation. It's 19 trillion US dollars, right? So that's 19 times roughly as much as Bitcoin. So for going to your compliance manager, your risk manager, I don't know, they will be inclined to go to gold first because it gives them size and liquidity. And I think we should not underestimate that. And that is also why I like both. It's a path. At some point, it could well be that when everybody embraces Bitcoin and the convenience of paying with it is easier than with euros or dollars, but it has to be better, not the same, because most people will not think about that. If they can spend Bitcoin as easy as euros or dollars, they will continue spending euros and dollars because they don't understand what is going on behind it. It has to be easier. But at some point, you meant the word leapfrog, it could well happen, but I think it's a gradual path. We go through gold to Bitcoin. So the guy or girl who dare to asked his boss, let's do a little bit out of the bonds, away with the bonds, into gold. After a few years, he will say, let's do another one, but now let's take Bitcoin. Let's do 1% or 2% Bitcoin. This is what I think will happen, and that is the money or the return is being made on that path to some endpoint we don't really know. Not the endpoint. Bitcoin maxis are totally focused on the endpoint, which is intrinsically uncertain because it's 20 years from now, 30 years from now. So I cannot forecast that. And so I like the gradual path of having both. And I think that is where the return is made when you take volatility into account, of course.
Yeah, the incremental steps are the important part. The smartest people I've known and know the bookends where we end up, but it's actually how you build and stay alive in between now and then is the important factor. And the analogy, or it's not apples to apples, but it reminds me of it's like going to an investment manager and say we're going to go into venture all in. It's like wait, let's start with the equity profile of like an Amazon or whatever, and then we'll go down. And venture is very similar to how I could imagine what you're describing, a conversation we're just going to eight-ball into BTC. It doesn't make complete sense.
No, nobody dares that because there's a clear career risk, right? So this is the traditional world. It's not called traditional for a reason, right? So it will take time. But yeah, I'm also here, so why not all the other ones? So that is the idea. And I wanted to go not slowly, but not too volatile, perhaps that you can expect to a certain extent what will happen. That is much better for your risk return profile than going all over the place and calling the end of the financial system every day. Not necessary also in my view, but that does not. I don't think that Bitcoin will come out on top at this point, because it does not have the track record of being that safe haven. So you don't want to have that. You can believe in it, that's fine.
Yeah, I'm curious as well on that, just in terms of institutional adoption of gold, because I came from a traditional finance background as well, and I was always amazed by how little exposure traditional allocators had to gold, precious metals, or commodities in general. I'm not sure if that was your experience as well, where typically it was a very small sleeve of the portfolio, if it was there at all. and how has that changed over the past couple of years? I'd imagine, and I'd love for you to correct me if I'm wrong, but I'd imagine some tailwinds for gold in institutional portfolios would be just heightened geopolitical risk and people seeking a more neutral type of reserve asset in portfolios, and then also heightened inflation over the past couple of years, looking for ways to preserve purchasing power and not have negative real returns by holding bonds. And then maybe it calls into question, some folks are thinking about the U.S. Treasuries as really the linchpin of global financial markets and the increase in volatility there over the past couple of years. I think the MOVE index is much more elevated than it was 5 years ago, isn't it? So yeah. Are these like some of the themes that you think are being discussed in institutional investment committees, or am I wrong there?
Yeah, they will have to. So I love this question because it gets me. So as a multi-asset investor, you always have the question, what is your strategic asset allocation, right? That is it. And I don't know if I'm allowed to say that, but that is a cover-up job. What you do, you look at historical data. You look at as much historical data if you have, and then you say, this is history, these are the risk return, because it's not my decision. No, it's the data. This is the data. And for a very long time, that 60-40 portfolio brought you a lot of good data, so to say. So you did a mean variance optimization, and you said, no, this is it. So pretty close to the 60-40, some bond like high yield bonds you added, even though that is an equity asset class. Just look what happens when equities go down, right? But this is you use data. So a lot of these traditional investors, asset allocators, they are backward looking. They use the data in fear is maybe too harsh, but the forward looking aspect, that is the second one. But the interesting part is now, I just did a post on gold versus bonds the other day because of the Dutch newspaper saying that 21. So the last all-time high in the Bloomberg Global Treasury index was when? Have a guess? 2020. 2020, yes, 4 years ago. 4 years ago, there was the last all-time high of this safe asset that is going to give you a return almost everywhere. If you go back 10 years, then you see that the return on the global treasury index was 2.1% on average annually, right? 2.1%. This is if you hedged to US dollars, but I'm in Europe. If you hedge to euros, which is a less attractive currency, then it was 0.4%. And if you did not hedge, it was minus 0.7%. This is without inflation calculated. I can also add you some global inflation for the last 10 years was 5%, and it was more than 6% over the last 4 years since that all-time high, right? So the longer it takes, you can also create this chart from 1976. Now you can go back to 1976. Bonds did not beat gold. So there you go with your data. Your robot, your algorithm, your mean variance optimization will screen. Matt Faber, you know Matt Faber, he did a very simplistic study showing that the Sharpe ratio of a 60-40 equities bond is now pretty much the same as a 60-40 Sharpe ratio for 60-40 equities gold. If you take a more recent period, the Sharpe ratio of the 60-40 with gold is higher. So if this continues, and I expect it to continue, even without any forward-looking indication, with any boldness in your forecast, the models will scream, if you have two assets that have the same diversification benefits, why not take them both? So that means 20% gold and 20% bonds. I don't know, something like that, right? It will be very hard for all of these number crunchers to keep continue saying we don't have to change anything. So that is one thing. And then, of course, maybe then if you include, and I think you already said something, if you include some forward-looking, the whole let's have a market-driven gold standard, is debt really attractive? One of you said that debt is getting more volatile. The realized volatility of treasuries, but also outside. So treasury is a special status. They are the preferred or required collateral in the world. Italian bonds, not so much. So the relative volatility of bonds versus equities is spiking. It's not going higher, it's spiking higher. Again, this is not just about returns. This is also about diversification benefits. And this is about volatility. These are the inputs for these mean variance optimizations, right? It's going to spit out an increasing amount of the other asset, in this case, gold. You cannot continue believing, and this is on hard data, no forward-looking aspect required. When you do that, when it spits out 4% gold, you want to do 8, right? That's another thing. But even historical data will push traditional asset allocators towards gold. It's stupid not to do that because the data tells you so. Apart from the fact that you should not build a whole portfolio around historical data. But this is what I do a lot of research on this. How far can we go back to see that gold is not less or even better than bonds in a multi-asset portfolio?
How do you think about, it may not come up, but curious, counterparty risk? Because I feel like everything you referenced is completely valid, and to add to it, you add the counterparty risk dependent on the underlying. This might be an unfair statement, but it's the way I think about either gold or Bitcoin is like I can eat it in the sense that I can take delivery if I wanted to, depending on the construct, and I can transfer it into the market. Somebody individually appreciates it, will take it, will give me a cow, will give me food, will give me anything that I need in the physical world, where equities and bonds, depending on what you're invested in, how far you're on the risk curve, they may not actually be transferable for anything that you need in the real world, specifically bonds and the counterparty risk with debt. How does that come into your kind of logic, thought, custody, your client base, or is that too far? Because I do know a lot of the things I just said are still maybe taboo in some traditional models. Or
could I add to that as well? Just because I've noticed you've explicitly said physical gold a number of times, right, in conversation today. So we're talking about a distinguishing between actually having physical gold secured in a vault versus having claims on paper gold. And so really curious to hear your thoughts on Michael's question, and then maybe in addition to that, thinking about some of those counterparty risks and institutional investors thinking about allocating to gold, would they actually look into physical gold or would they lean toward paper gold?
Yeah. So first, why physical gold? So so let's go back to the gold standard. You had central banks. So again, an example from the Netherlands, but they invited, I think, 20 journalists to come and look, because the Dutch central bank has quite a lot of gold. They invited journalists to come and watch that gold and then do a little bit of talk. And also the boss of the Dutch National Bank is a very big fan of gold. So you wanted to have there. So if you say, I trust my dollar or my euro because I know that my central bank somewhere safely has stored that physical stuff that we all believe that is worth, that is, of course, then you must be sure that your central bank is able to get it. They have their own vaults, they can touch it, so they can actually use it. The whole concept is the same when you believe that scarce assets will be, as mentioned before, a market-driven system to get more trust in the system with all of this debt. That means that the relative value of gold and Bitcoin and all other scarce assets should rise relative to debt. Then you solve part of that problem. Then you have to be able to touch it, or it is actually in your and then you have different varieties of that. So first you have paper gold ETFs. I think a lot of traditional investors that do not doubt the financial system or have no trust issues concerning the amount of debt in the financial system will go with paper gold. Then you have the physical gold ETFs. The thing there is that you have 80% coverage. It's something like that. It's not 100%. And also there's no name. Your name is not on the bar number, for example, right? So then it's, I think, pretty straightforward. I thought about this when designing the fund. If this is my basic idea, that I believe that gold will be, once we have some kind of new gold standard, digital gold standard, then I must be 100% sure that the gold of my investors is the gold of my investors. It has to be physically somewhere to be able to join that right, and you don't want any hiccups. Now, then is the question why it's in Switzerland. Switzerland does not have an official law that it can confiscate it when there's something bad happening. Either way, when something bad happens, they will go after your cash money or your digital cash money at the bank accounts. That's with a strike of a button, that's there. So in the Netherlands, there's 600 billion euros in savings. So they will not go after your gold anyway because they don't need it. But that is so. On the counterparty thing, okay, my idea is I'm the counterparty for my clients, but then let's stop there. Let's minimize the counterparty risk by having these gold bars. And it's not that the infrastructure is not there. There are so many companies doing this. So let's do this. So that is the idea. If you have this whole scarcity, it has to be tangible. It's your store of value. Let's make sure as much as possible that it is your store of value. That's the simple reason. And then still there are people that I talk to, they say, Jeroen, I really like your fund, but I'm never going to invest with you because I want to be my own counterparty. My gold is 10 yards out in the garden, then so many yards deep. That is there. They don't want me as their counterparty, right? So I think that is going because being your own counterparty risk is not safe, to be clear, but okay. But this is why it's in a vault in Switzerland. So don't have any argue. I will have arguments with traditional investors that say that this is more expensive than having a paper gold ETF. Now and then we have this discussion that we are having. I try to explain, and I hope that they understand. I think they will do.
Yeah, risk adjusted, it's cheaper. Nominally, it's more expensive. Risk adjusted, it's cheaper.
Yes.
Does your Bitcoin custody setup keep you up at night? Maybe you still have coins sitting on an exchange worried about hackers. Or maybe you've set up your own self-custody but don't feel safe with your Bitcoin savings stashed on a little plastic device in your desk drawer. Gain peace of mind with Onramp and our multi-institution custody solution. Here's how it works. Onramp creates a dedicated multi-sig vault just for you. 3 separate institutions each hold a key. Onramp, BitGo, and CoinCover. But none can move funds unilaterally. Instead, only you have control over your coins. With Onramp's multi-institution custody, you'll sleep better at night knowing your Bitcoin is stored with best-in-class security on-chain with fault-tolerant multi-sig. If you believe your Bitcoin is going to be worth a lot someday, don't jeopardize that future by exposing your coins to hackers on exchanges, $5 wrench attacks in the real world, or perhaps most importantly, the risk that you might screw something up with a highly technical self-custody setup. Onramp's multi-institution custody eliminates single points of failure, reduces your personal attack surface and technical burden, and provides access to financial services that allow you to confidently secure your Bitcoin, including inheritance planning, insurance-backed warranties for all balances and transactions, low-cost trading, and more. Bitcoin is a once-in-a-species asset. Secure it right. Learn more at onrampbitcoin.com.
Yes.
And I'm curious on that. So as you're having flows in and out of the fund and you're trying to rebalance the relative proportions of those assets, how do you find the experience of adding or subtracting gold from the vault in Switzerland versus adding or subtracting Bitcoin exposure?
Oh yeah. Now, so for me, it doesn't really matter that much because I have partners who do that. So I'm experienced multi-asset investor, not a gold vault allocator, right? So that is, you have to be very clear on what your expertise is and what not. As mentioned, there are so many people or companies that can do that better. I don't feel the hassle. Perhaps also because we have not had 1 month that anybody exited the fund. We only had the inflows, so that's easy for now. But I think having the right people who are specialists on their area is what you should incorporate. There's no upside in reinventing the wheel every time. So I reinvented the wheel with this fund, I hope. But then you use the expertise of others And that's the same with Bitcoin. And there's also when you trade the quality stocks, right? So you build on the infrastructure of others. So in the end, there's always a bit of counterparty risk. So yeah, that's
Yeah, it was very informative how you thought from a first principle perspective of the custody and counterparty risk, because Jesse and myself, as we went back to 2022 and saw, if you're familiar with the Grayscale Trust and all the mishaps that happened there, we saw multiple layers of counterparty risk. We like to say, like, it kneecapped the properties of Bitcoin by at least 50% in the sense that you couldn't take the under delivery of it, right? It was a closed-end fund. You had to realize the taxable event. And in a very similar vein, you don't have to, you can reduce. There's always going to be counterparty risk, but we ultimately, it ended with us. And then you can start to distribute. If you're familiar, we have the keys that are distributed globally. The client end state has optionality to take delivery, and you start to map to these, I think where you said market driven, I think ultimately what we see is these are market-driven demands that will occur over time as inflation persists, as counterparties, especially we're like in Bitcoin and crypto, it's just accelerated versions of what's happened in the traditional world, in the sense of like these cycles that we see every 2 to 4 years, or like maybe every 10 to 40 years that we see in the traditional financial world, that we see these belly ups where the counterparty has zero Bitcoin. And it's important to design products where you can take the delivery if you can. So it's very similar what we set up, just on a sliver of just BTC, but not having a single counterparty on the custodial side, because that is the value prop in our opinion with Bitcoin versus gold, is that you don't have that centralization risk that traditionally is inherent there.
Yep.
But then also there's no reason to not have it not deliverable. It's almost a check on the system to make sure that you can take delivery if you wanted to.
Yeah. Yeah, I agree. And I think that's a rough estimate, but I think a third or something like my investors are really drawn to this aspect. The most questions are, is it ours? Because it's a fund, but is it ours? Is it somewhere safe? Why do you do this? What is the counterparty risk? And for others that are more from the traditional world, and this is interesting because when does an equity investor at a well-known bank or asset manager ever question if the depository that the custody service that he takes, it's never questioned. My guess is that it's also pretty solid, but it's never questioned. But with gold and Bitcoin, it is. But my question would be then ask everywhere, also for the traditional part. So I find it very comforting, and I'm very happy that I made this decision to do it like this, because, as mentioned, a lot of my investors have these questions. So reduce counterparty risk, and at some point, I'm willing to have some, because I'm not a specialist on everything. But yes, it's and if this is also what I say to my clients, if there are developments, especially of course in the Bitcoin world, which make that custody better, then you should change. It's an hassle, but you should change. You should try to have the best custody, self-custody, or that is possible. And yeah, my guess is of course that Bitcoin will change in that area a couple of times already. So you guys know better than me. You have to be on top of all these developments every day to make sure that this state of the art and counterparty risk is minimized, even though it will never be zero.
Yeah, I have Jeroen, I don't know if you'll agree with this, but I'm going to throw it out because it's a very controversial take, at least in my mind, is that you hit the nail on the head earlier, referencing you need specialists, right? That's what you trust specialists that are native, and that I think, even personally, you think BlackRock, Fidelity, the largest institutions will come in and be able to adopt this asset and think of it and build productive assets. And I'm increasingly coming to the belief that it's actually not true. And the best analogy I can describe is, because this is so, I don't even want to say disruptive, it's just such a radical idea, from the volatility aspect all the way to how do you build financial products and the custody nature. that it's like Instagram going to Kodak. If you're familiar with like the Kodak from the late 80s and 90s that were doing the
Of course.
like Polaroids in the film.
Yeah,
It's like Instagram building on a different platform to go back to Kodak and to ask them or to to use their leverage their solutions for a completely different game. Except for this one has a unit tied to it, which effectively you can lose, and there's investors' capital at bay. So anyway, I don't know if you have any thoughts or comments, but it's just something I think about in the traditional sense that this is such a radical new thing that the old counterparties will probably not be the future leaders in this particular field.
I'm definitely not a specialist in this area, but what I do know, when these spot Bitcoin ETFs, US spot Bitcoin, were approved, the way that they had to do their transactions, the whole in-kind thing, there had to be another counterparty involved that does the actual buying. If you look at the number of counterparties that you have with this ETF, these are massive. So they are more than a regular equity ETF. And I think when it comes to, so I think this resonates with your idea. You're trying to build something that is what you call radically new, on top of an existing infrastructure, with also a regulator that says you have to do it on the old system. So yes, I agree that there is lots of room for specialists, let's call them like you guys, to stay in front. I would expect that, because these old models are not fit for this whole digital store of value thing, custody thing. And so yeah, I agree, as far as I'm equipped to tell something about that.
Yeah, I think you made such a great point earlier too, just on how custody is virtually an afterthought in traditional financial management, right?
Yes.
In your 20 years of managing portfolios, I'm sure custody was toward the bottom of the list in terms of considerations when allocating capital. And not to diminish the value of custody in traditional assets, but more so the idea that investors are focused on other things in terms of delivering returns to their investors, choosing asset classes that have low correlation to benefit portfolios, being strategic and tactical in terms of how capital is allocated to meet changing macro regimes, or how fundamentals are changing within an asset class. But it's so different to approach something like Bitcoin, right, where the alpha isn't necessarily trying to outperform the spot Bitcoin price. The alpha is more so having exposure to Bitcoin, and in your case, it's 10% of the portfolio. But really crucially to that is securing it the right way and thinking about counterparty risk first and foremost as part of that allocation. And I think that just naturally stems from Bitcoin being a scarce bearer instrument, where if those private keys are lost, more likely than not, those Bitcoin will never be recovered again, which is entirely different than the traditional world where custodians are record keeping for equities or commercial real estate, whatever asset class it may be. And those records are maintained in many different places, and losing the record doesn't necessarily mean that the asset is lost. So I think that's part of the reason why counterparty risk should always be part of the conversation when allocating personal capital or on behalf of investors to Bitcoin and the broader crypto space. And we're seeing kind of in real time the challenges over the past 15 years of custody in Bitcoin. There's been nearly $400 billion of lost capital from counterparty risk. And that's only in a $2.5 trillion market. So these are considerable losses. These are things that have never been seen before in traditional markets, just because it's a totally different asset that requires new types of infrastructure and custody. So not curious if there's any thoughts on that directly, but more so just an observation of what we see trying to map the old world to the new and some of the frictions and risks that brings for investors.
No, not. I think that's a very good explanation. What I could add is that from that perspective, gold, but also Bitcoin, even though it's digital, has to be tangible. It's representing a value, and if you lose it, then it's gone. Whereas a stock is, of course, an instrument from a US dollar derivative, would Michael Saylor say, right? I think that is, that I can, you want to own it, touch it. So for Bitcoin, that's of course not physically possible, but that is what represents its value, right? So if you lose it, and this is also, you mentioned, of course, Bitcoin, but if you lose digital money, a lot of the times your bank will reinstate that. When your credit card is stolen or whatever, a lot of the time that will be reinstated. And of course, there's a security or an insurance behind that. But that already, with gold, would a large bank put other gold back into your vault when it's lost? Most likely not. So I think this distinction is, I think, fair. I think you described it better, but yes, I can relate to that idea. Yes, and that's why custody is important.
Yeah, appreciate that. And maybe we're coming up on an hour here. Might be good just to get a pulse on what you're seeing in terms of appetite for Bitcoin and digital assets, in the Netherlands or maybe just Europe more broadly, because we're all the three of us are based in the U.S. We have conversations and clients in Europe and globally, so we have these conversations. But I'd be curious to hear from someone who has had a career in the Netherlands and Europe and been allocating capital for 20 years, and now thinking about Bitcoin as part of a portfolio and how are individuals or institutions perceiving it? I know we talked a little bit about it, but how do you think maybe the next cycle or two look for Bitcoin and investors starting to incorporate that more broadly into asset allocation?
Yeah. And Jeroen, just to add one point, to maybe in contrast to gold, because I'd be curious, like how your conversations are going from a market interest and demand, gold versus BTC, and is it more weighted in one direction versus the other?
Yeah. So concerning gold, I think when you start in a traditional investment firm about gold, that's then a topic on the agenda. It's most likely not in the portfolio, but it is something that I would not say everybody, but a lot of investors, we had a discussion about running the numbers and looking at historical data. They should be, and my guess is they will be aware of the diversification benefits, to put it in one sentence, of gold in your portfolio. So that is one. And I think, and this is perhaps the interesting part of my answer, I think truly traditional investors will use this to not talk about Bitcoin. So this is their defense. Yeah, but we have no track record. But let's focus on gold first. This is already different than what we do. Let's do one thing at a time. I know from the other side, so the how do you do the demand pool or I don't know, but the investors are very, very aware about the other asset classes that are out there. Let me put it like this, and that means that an increasing number of asset managers, bigger asset managers, now actually get requests on, do you have solutions including crypto? Most of the time it's crypto. Do you have funds that have equities, for example, that have specific exposure to Bitcoin mining, Bitcoin related, MicroStrategy, all of these. So the bottom-up demand is definitely there. I think this is I don't want to be the first mover because whatever happens could. So my understanding, as far as I know, is they will use the discussion about scarce asset and gold in a portfolio to shield from the discussion of Bitcoin and definitely about crypto, which is not Bitcoin, of course. At some point, and this is why I like the stories coming out of the United States, that two of the state pension funds, and one of them, I looked down how is the board of investors received, how are they looked upon. They are known for their innovative nature, but also that they are very, let's say, skillful, knowledgeable, whatever. So my guess is that in the end, clients will continue to push for them. My idea with the bigger institutions or the traditional investors is that they are in no hurry to be in the front of this movement. So, and of course, for me, I'm extremely happy about that because that gives me time to create a track record. So that is so. The world is pretty much divided in crypto specialists, crypto asset managers. There are even I looked up the combination of gold and Bitcoin. I think I have 5 or 6 competitors globally, and even they don't come even close to what I do, even though they have some of the same. Whereas if you want to have an MSCI World fund or ETF, you can pick thousands of them, right? So I thought I expected it after the last upcycle that we would be a little bit further ahead. But even with the spot Bitcoin ETFs, and this is you know better than me, and but in Europe, this has not ignited some kind of spark. Oh, but now it's for me as an advisor, it's pretty straightforward. I don't think this is the case. I think clients will ask, and behind the scenes, bespoke, they will get it. But it's not that there are massive number of traditional investors coming out with reports. You should do this and you should do this. It's always Van Eck and others that we already know, ARK, the usual suspects. So I'm waiting for the traction. I'm not seeing it, but perhaps also because Bitcoin is not at an all-time high and gold is. But I'm waiting for it. But if it takes a little bit longer, give me some time to build that track record, guys.
Yeah.
I'm happy to do so. So yeah.
And it's an advantage to people like you who can see the data, think critically and move before the big guys with their career risk and can take action. I think the game plan was laid out best by Paul Tudor Jones in May 2020 when he said Bitcoin's going to be the fastest horse this decade.
Yeah.
So far, he's been right, and I think that'll continue to be the case. And again, I think you're right that there's interest when scarce assets are at all-time highs, and so we probably have a little more time before the halving does what it does, and the price drifts up into all-time high territory in the coming months, and then there's going to be a lot of people giving you a call, Jeroen.
Yes. I hope so.
Your excitement is it's palatable in the sense of like I'm excited for you that you're just in a prime position. I'm a little like jealous in the sense of like because
of my energy level, I get that a lot.
No, I in our internal meetings I can be pretty high energy, but I'm just thinking about like the nature of your products are so suited for a market, as you referenced, to incrementally come in. And you referenced nobody really doing this. The one guys that I think we're familiar with is Incrementum. We've had some of the team on, but they're gold Bitcoin without the equity component, which I think is crucial because gold Bitcoin by itself, you end up in a kind of, I don't want to say doomsday scenario, but you end up with a certain cohort of the market versus somebody that is wanting to, move that bond exposure out for other assets that are empirically performing. But then also to your point, where I think we're all aligned that, this has moved a little slower than we thought, especially after 21. And what we found, and it's probably similar to you, is like we talk with a lot of institutional investors on the pension side. And there's two parts. There's the one that is career risk. So they're just waiting for more people to step in. They're all acknowledge there's an asset class here, but they don't know the difference between digital Bitcoin and crypto. And they lump it all in together. So that's inherently keeping them from understanding any of what we're talking about because they're thinking about it all of it as a risky asset. But to your point, it's kind of great for us because we get to build out all the like muscle memory and all the fibers of like, how do you educate? How do you go into the Schwabs and the Morgan Stanleys and educate Bitcoin only? How do you evaluate it? How do you think about risk? How do you build custody? Because nobody else is doing what we're doing in the sense of, I said we're jealous, but in the other side, I'm not necessarily jealous because we kind of, our bank is that this is the future. And if we become the best at it, then that's where everybody's going to. So we're just like in a different side, but equally, I think you're doing very interesting stuff and it's very exciting.
Thank you. Yeah. So yeah, I agree to that story. Yes, it is a little bit slower. maybe not even then expected, but when you talk to clients, this is an asset class now. So people want to deny that, and it's fine, but this is an asset class. It's a small one, it's an illiquid one at some point, it's a volatile one. But yeah, so, I think what we share is that we have to be patient. So there is nothing coming out in the sense of data or developments that does not stick with the story that you should truly diversify your portfolio. And that means away from the traditional bond thing, but also from the traditional thinking. And I think the easy part with gold is that it hits an all-time high. People write more about it. But yeah, that neatly fits my idea. That's one step first for the traditional world and then the other, but it will come. So when you start a fund, of course, you have very strong conviction on your own philosophy, but I can say with 100% honesty, I've grown so much stronger on the philosophy. So I'm so much convinced this is something that has a long way to go. And that feels great. So also when it's a day, it's not great and things go down or whatever. But so I think we are on the solid page. And for me, it feels wonderful to be right there in the middle.
Yeah, and it took 5,000 years, 6,000 years for gold, to build that history. And so we're only 15 years in with Bitcoin. Yes. And I think that, every single day, I think you're right, that every single day, some smart investor looks at the numbers with a realistic, objective lens and says, you know what, I should have some gold and I should probably have some Bitcoin. And I maybe don't want to have all these bonds. And that process plays out day after day for the next couple decades, really.
Yeah, that's exactly my thought.
And that flow can stay contained, which is exciting, because generally if somebody has exposure to gold and naturally moves over to Bitcoin, you can support there in that rebalancing or that increasing exposure versus having to go somewhere else, which is just going to be congruent with, I think, everybody's thesis here is like assets are going to move into gold or BTC, and you can naturally help with that versus seeing that flow go somewhere else.
Yeah, agree.
Yeah. So to wrap up here, maybe we have 4 months left of the year. If you want to just give us, Jeroen, maybe a minute or two as to what you're paying attention to in markets, maybe what listeners should be thinking about as well. Could be really to any of these asset classes we've discussed today, or even broader macro thoughts too.
Yeah. Well, so I think the broader macro is, of course, the elections, the US elections. And to fit that on the philosophy, I think in the situation in the US is perhaps a little bit more extreme because you only have now 2 people left to vote, but there is no middle, right? The middle is completely gone. But also in the Netherlands, you have 20 to 30 parties. It's crazy, but still. But even the ones in the middle have left the middle. And I like voting in the middle. I like the middle, and then I lean a little bit towards this and that. But I think a lot of people in the democracy like the middle. If you add to that this polarization leads to ever more aggressive behavior, data sharing, financial media. What do you believe? This underpins the notion that trust in general is declining. So if you don't have trust in general, how will you trust your financial system with all of this debt going up? So I think in the end, this is the US elections are good for the whole philosophy, but not necessarily the world. And also I'm very, it's very clear that whichever one wins, that the budget deficits will remain, one way or another, right? So I think that will be a very interesting topic because it will shape the landscape, what you see with Trump and China for years. So that is one thing I'm keeping an eye on. The other one is, of course, a little bit closer to home. Do we get that US recession or not? So the jury is still out. That will determine, again, bringing back to the previous topic, the pace of adoption, the pace. So if we get a recession and everything goes down 50% or whatever, then this phase will be pushed back a year or 2 years. And so if we don't get one, then then it's likely confirming my thesis that central banks have to keep rates low because that sustainability is an issue that fits the whole liquidity story. So I think these are the two, let's say, a little bit closer to home for the rest of what will shape the trend of markets. So yeah, these two things.
Yeah, those are great points. The U.S. election is certainly highly anticipated and could impact many different things, including our industry and Bitcoin. At this point, there's kind of two different stances there, but generally agree with you that kind of regardless of who's in power, what we're seeing is continued kind of irresponsible fiscal spending, and there's really no incentive for that to stop. So agree that scarce assets are really the way to go here in terms of preserving purchasing power, and really appreciate all the insights that you've shared with us today. Kind of a remarkable journey and investment philosophy that you have, and I'd imagine that more and more people into the future, whether it's 5 or 10 or even longer from now, will have portfolios constructed similar to what you're doing with the Blokland Fund. So, it was just great to learn more about it. To wrap up here, where should people go to just find more about what you're working on and get in touch with you?
Yeah, so we have a website that is bloklandfund.com, and then Blokland, not with CK, but only the K, as in my name. From there, you will get the fact sheets, the philosophy. You can download the presentation, bloklandfund.com, and then you can also contact me directly. So whenever you reach the website, you will be all right.
Very cool. Thanks for running through that. I would imagine you're going to have some folks reach out. So it's awesome.
So.
Appreciate
it.
Okay. Yeah. Thanks again. Great to meet you. Appreciate you coming on today.
Yeah. Okay. Thanks for having me. Ciao.
Thanks for listening to this week's episode of the show. If you found the information valuable, please share the episode with a friend or leave a rating on your favorite podcast app. All the links we discussed in today's show will be in the show notes inside your podcast app. Before we finish, a quick reminder that Onramp Media is for informational and entertainment purposes only, and nothing should be construed as investment or legal advice. Regardless of where you are on your Bitcoin journey, we'd love to hear from you. Visit onrampbitcoin.com/contact to schedule a consultation with one of our private client advisors.